Hey guys, happy Thursday. Happy Thursday afternoon. It's afternoon everywhere except for, I guess, the Pacific Coast. So if you're watching from over there, still good morning to you. Let's get the window out of here. All right. Hi, everyone. As you jump in, let me know where you're from. Welcome to our first weekly live training. If and we'll just jump in. We'll just go ahead and jump right in. If you don't know me, I'm Bree Beers. I own Bree Beers and Associates, which is a tax preparation and planning firm located here in Colorado. We work with clients across the country, though. We are in our 7th year in business, and we work with small businesses and complex individual tax returns. So complex individual tax return is if you have more than your W-2, right? If you have rental properties, investments, maybe multiple businesses or any sort of business, thing like that. That's what we consider a complex individual tax return. So that and small business tax returns, specifically S corporation returns and even partnerships, kind of our jam over there. I'm also the founder of Peak Prosperity CFO. We empower owners of 7-figure businesses to boost their annual compensation by $100,000 in the first year of working with us by providing profit-centered thought leadership. What that means, there we go. What that means is we work with 7-figure business owners who are feeling stuck because they're wanting more work-life balance and more money in their personal bank accounts. So that is a little bit about me. If you are also new here, whether you're OG or you're new. So I was doing weekly lives and Q&As. I think I started back in 2020. Definitely was doing them when pandemic hit. Coming on here and teaching people about PPP and EIDL and all the disaster relief that was out there, and trying to keep up with all the ever-changing items on that front. And then when that kind of slowed down, kept on here, was still helping people, answering questions, kind of talking about different tax-related things, and then took a break, just got burnt out. I think we all do at one time or another, right? Just got to the point where I kind of had to reset, so did, and then did a 3-week training series here. Just wrapped that up last week. Did 9 different training series and a Q&A. So if you love hearing me talk, go check that out. But today is our first weekly training, and today we are talking about KPIs. So let's start with what is a KPI. So KPI stands for Key Performance Indicator, all right? And what, in simplistic terms, what it is, it's just something that you track in your business that is quantifiable, that is measurable, to see how your business is doing. All right. Typically, KPIs are something that you can get from the financials or get from your financial system, right? Maybe you're tracking something like profit or cash flow, or maybe job costing, right? If you have multiple jobs, maybe you're trying to figure out which job is the most profitable. There's also KPIs that are not related to the actual financial part of things, such as customer satisfaction, customer efficiency, customer retention. So anything that is measurable can be a key performance indicator or a KPI. And you can track anything, right? But the key, guys, is to make sure that the key performance indicator, the KPI that you are tracking in your business, is important to what your goals are and what you want to do with your business. So a question I get asked a lot is I'm small, I just started, I don't need to track KPIs, or that's not something that's important to me. But at any size, you should be tracking your progress, right? Really, that's all it is. Tracking KPIs is a fancy way of saying my business is tracking our progress and making sure we're moving forward. All right. And as you grow bigger, right, as your business grows, you may track more KPIs. You may change the KPIs that you track. But I stand by, if you did my training over the last couple of weeks, you know that there are two KPIs that I believe every business should be tracking. And I believe no matter how big or small you are, these two areas are important. And they're something that if you track them and you are monitor them and you set goals for them, you will grow. All right. First one is profit. The profit of your business. And you can look at profit dollars. You can look at profit margin, profit percentage, whatever you want to call it, but essentially looking at how much your business is making. All right. So you can look at the dollars. You can say, okay, we want to make $100,000 in profit this year, or we want to make $10,000 in profit this year. Or you can set a profit percentage. We want to increase our profit percentage by 10%, or we want to have a 20% profit margin this year. So there's a lot of different ways to set a profit KPI, a profit goal, but monitoring your profit and making sure profit is one of your business's KPIs, always my number one suggestion. Monitor that profit, all right? Because you guys know you can have a 5-figure, 6-figure, 7-figure, 8-figure business, which when we measure the size of a business, we're typically looking at revenue, right? Annual revenue. So if I run a 7-figure business, that means I'm bringing in 7 figures of revenue in a year. But you can have a 7-figure, even an 8-figure business and be losing money, okay? And so you want to make sure that your business is profitable. Why is that important, right? Why is profit an important KPI to track? All right, well, profit, right? Again, if you're not making a profit, you're not making money. Your business is not sustainable if you're not making money, okay? So profit and tracking profit means I am making sure that my business is making money, all right? Another reason profit is important is, is because you got to pay taxes, okay? And that to pay your taxes has to come out of profit. So you want to make sure you're setting your profit goals at a level that will take care of your tax bill. Not every CFO is going to tell you that, because a lot of CFOs work for the business and not the business owner. But so let me give an example. Let's say your business, whether you're a Schedule C or an S Corp or a partnership, let's say your profit is $100,000 this year, okay? And that's your goal. You want to make $100,000 in profit. All right. Well, from that $100,000 in profit, you're going to have to pay tax on it, right? So you want to make sure that you have the cash to do that, which leads into my second KPI, and that's tracking your cash flow. All right. So profit number one, because if you do not have a profitable business, you do not have a sustainable business. Number two is your cash flow, monitoring your cash flow reserve, your cash flow projections, cash flow, whatever you want to call it, but looking at how much cash you have, doing forecasting of how much cash you're going to project that you have over the next 12 months to make sure that you have enough cash to keep your business going. And cash flow is important for a few reasons. One, cash flow is important to make sure you have a rainy day fund or an emergency fund, to make sure that you're building that cash stash. All right. Cash flow is also important because if you are a seasonal or a cyclical business, you want to make sure you have enough cash to get you through the slow seasons. Tax prep is a perfect example, right? Our busy season is February, March, and April. It's when we make any tax business makes a very big chunk of their annual revenue, right? And then the summer is slow, and then we get a little busier at extension season. So August, September, October. And then if you do tax planning, you might get busy at the end of the year, but that summer is your slow season. So you want to make sure that in your busy season, you're not only making enough money to pay the bills and pay, those bills for those months, but that you have enough cash reserve to pay your bills during the slow months when your revenue goes down. All right. So profit and cash flow, two most important KPIs, two KPIs that I believe every single business should be tracking. Another reason, that cash flow is important is because not everything is on your P&L. All right. So let's go back to some basic accounting, which some of you may not even know this. So for some of you, this might be new news. All right. So we look at our profit and loss statement, right? That's our income statement. So we have all of our revenue, how much money we brought in. We have our cost of services or cost of goods, all the costs associated with providing our good or service. Then we have all of our other expenses, right? And that brings us to our net profit for the year or for the month, for the year, for the quarter, for the business, right? But there are things on your P&L that, or there are things that run through your cash that take money that don't hit your P&L. And there's things that hit your P&L that don't hit cash. So depreciation and amortization, those are things that you'll see on your P&L. They're an expense you get to write off, you get to take the tax deduction for, but it doesn't involve spending cash, right? And on the flip side of that, there's usually a number of items that do not hit your P&L, but affect your cash flow. The biggest one being debt repayments. All right. So something to remember when I borrow money, whether it's on a credit card or it's a mortgage or it's a car loan or it's a loan for machinery that I want to buy or it's a line of credit, doesn't matter. When I borrow money for any reason, it's not considered income. All right. I can get a loan for $10,000. I can get a loan for $100,000. I can get a loan for $1 million. It's not income to my business. I'm not going to be taxed on that money because it is not income. It is money being lent to my business. All right. That said, the flip side of that is when I repay the debt and I repay the loan, that's not an expense to my business. So as I'm repaying my auto loan, my machinery loan, my line of credit, my mortgage in my business, that's not an expense so it does not hit my P&L. But for some of us, that can be a big chunk of money, right? Especially if we have an SBA loan, if we have a mortgage on a building, if we have a lot of machinery and we've financed that machinery. All of those payments, all of those loan payments, we need cash to pay them, but they're not going to hit the P&L. So that's another reason cash flow tracking as a KPI is important, because you not only have to have the money to pay your expenses, to pay, your cost of doing business, you have to have the money to repay your debts. All right. So that's the reason those are always my top two KPIs: profit, tracking your profit, and tracking your cash flow. So what does it mean to track KPIs? All right, what that means, first, it means that you're tracking it, right? You are looking at it on a regular basis, whether that's quarterly at the very least or monthly, which is ideal. You're looking at what is my profit for the last month? What is my profit year to date? What was my profit last year at this time? What was my profit all of last year? You're comparing today's numbers to historical numbers to see how you're doing. Are you growing? Are you shrinking? Are you making more money? Are you, how does that look? So you're looking at your current numbers, you're comparing them to previous numbers. You're also creating projections and budgets and goals for what you want to hit. All right. So when it comes to profit, let's say last year you look at your P&L and you're like, okay, we made $100,000 profit, but we didn't get to take much of that home because we paid, we had $80,000 in debt. So this year we want to increase our profit to $150,000. $150,000 profit, all right, is our goal. And then we're going to set steps to track that to make sure we're hitting that goal. All right. Same with cash flow, right? We want to set a goal of how much cash do we want to generate each month, each quarter, each year. We want to look at what we did last year. How much cash did we produce? How much cash do we have on hold? And then we also want to make sure that these goals are created with a purpose. All right. So when we're creating goals for KPIs, again, let's just start easy with profit and cash flow. We don't want to arbitrarily set these numbers. All right. We don't want to just be like, we want to increase profit by 10% next year. Or we want to make sure we have, $10,000 in cash at all times. We want to set these KPI goals with intention. All right. So how do we do that? We figure out what we're trying to do with those profits and with that cash. All right. And working backwards. So this is something that a lot of traditional CFOs don't do, right? They They look at trends. They look and they're like, okay, we're going to set these goals. Another thing, right? Sometimes we set them based on just arbitrary goals, right? Like, okay, we want to have $1 million company, right? But why do you want to have $1 million company? What is it you're trying to achieve by having $1 million company, right? So get into the why of why do you want $1 million? Why do you want to take home this much money? Why do you want to profit $100,000? Because when you know the why, you'll be able to set a more intentional number and goal on those KPIs. Let me give you an example. So I run a business and I'm like, okay, what do I want my goals to be this year? I start when I work with any clients and when I look at my own business, I start with my personal goals. All right. So the very first thing I do is I look at my personal budget, right? What do I need to take home in my personal life right now to pay my own personal bills? All right. Then I subtract, okay, how much does Travis make? Okay, he'll make that. So this is what I have to take home every single year or every single month or whatever I'm breaking it down to. Okay, this is the number I have to take home. Okay, and then I work backwards and figure, okay, well, if that's how much I have to take home, how much do I have to account for taxes, right? So that needs to bump it up, right? How much am I taking home through my payroll? Like all of these different factors kind of play into it. And that's what we do at Peak Prosperity. I'm in the midst of trying to create some templates and some little courses to kind of help those of you that aren't quite to that place where you're ready to hire a CFO, but you need that guidance. So give me some time. I'm working on it. But going backwards, you want to make sure that your business goals are supporting your personal goals. Your business goals are supporting your personal goals. All right. So in order to know that, you have to know what your personal goals are. So you have to know how much money you have to take home now. We have our clients make a 5 and 10 year budget where, what do they want to be taking home in 5 years? What do they want to be taking home in 10 years? Because it's going to change, right? We might have kids going through college. We might want to be retiring. We might have parents we have to take care of. We might have a dream house that we're wanting to buy. We might have a second house we want to buy, whatever that looks like, right? So our personal financial needs are going to change. Therefore, our business goals are going to have to grow with those personal financial goals. Are you with me? Does that make sense? That's so important. And that is like the foundation of Peak Prosperity CFO's platform, how we work with our clients. Is we start with your personal financial goals in order to build the business into an asset that funds those goals. All right. So profit, because profit is where we can take money home from, right? So we want to make sure that profit is enough for us to take home what we need to take home. It's enough to pay our taxes. It's enough to pay our debt obligations. Remember, because those don't hit P&L. So all of these things factor into how we set our KPI goals. All right. But what I want you to take away from today is that every business, no matter how big or small, should be tracking KPIs, at least profit and cash flow. Okay. How do you do that? You read your financials on a quarterly or monthly basis. Right? You're reviewing them, you're comparing them to historical data to see how you're doing compared to how you were doing last year, how you were doing last month, right? So that's the first step. Get into the habit of looking at your financials and tracking your profit and your cash flow. All right. And if you're in any sort of software, QuickBooks Online, QuickBooks Desktop, Xero, FreshBooks, all of these, they can produce that report for you. Your P&L or your income statement, same thing. And then your statement of cash flows is going to tell you how much cash you actually have. All right. And then, so you're tracking it. Step 1 is you're tracking KPIs. Step 2 is you're creating goals and projections for those KPIs. So you set your goal. How much cash do I need to be, bringing in? How much profit do we need to be making each month? Right. So setting those goals. And then the third one is the set projections, right? How do you get from where you are today to that goal? All right. And that is where you probably want some professional guidance, because you can mess with those numbers, you can change everything you want, but you got to know what changes need to be implemented to result in higher revenue, less cost of goods, higher profit, all those things. All right. So some other common KPIs that people will track or that businesses will track. Sorry, I'm just fidgeting and I'm dropping things. So some, like I said, some businesses, they want to track non-financial KPIs, and that's customer satisfaction, customer retention. So customer retention, really easy to track, right? You look at the number of clients you have each given in whatever time frame you're looking at. If you're looking at it monthly, month over month, quarter over quarter, year after year, and you can look at new customers that have come on in that time frame, customers that were here from time frame to time frame. Customer retention is how many clients were here last year that are here this year, right? Customer satisfaction, you measure that with surveys, right? You send out surveys to your clients. How are we doing? How can we improve? Or, are you happy with your service? KPIs from a financial point of view, other than profit and cash flow, you might look at job costing, right? So if you in construction, this is a really common thing, right? If I'm if I own a construction company and I have, I constantly have 5 or 6 jobs going, at the end of the day, I want to know how much money I made on each of those jobs. How much revenue did I make? How much did it cost to complete that job? So how much money did that job actually make, right? Because when we're looking at the whole big thing, we might make a ton of money, but we want to know where were we profitable, right? This is also important when you're doing smaller jobs than construction, right? I have a food manufacturing distribution company. What they do, they make sandwiches, they make burritos. So they want to know which sandwiches are making money, which burritos are making money, and not revenue, guys. Because what we find a lot of times when we start tracking KPIs is the product that brings in the most revenue might also be costing us the most. And we might actually be losing money on that product line. All right. So that's one way of kind of digging into KPIs and figuring out, okay, where are we most profitable and where might we be losing money? What you might end up doing is dropping a product segment altogether, so you can focus those resources on a more profitable segment. Another common one is liquidity ratio. So that's how, like if you needed cash, how fast could you get it, right? And a big one there is, especially in times of crisis or times of economic uncertainty, you do not want to tie your cash up into assets and inventory, right? And that's a tough one that we've been dealing with for the last couple of years, because a lot of different things, inventory sectors, it's the timeline to get our products or our supplies is really long. And so when we have the ability to get inventory, we want to stock up on it, right? But what if we stock up on it and we're not able to sell it? Or what if we stock up on it and we hit another recession and our demand goes down? Or what if we stock up on it and then the price plummets, right? There's so many reasons that you don't want to necessarily tie too much cash up into your inventory. So that's another KPI your business might choose to track. So key takeaways from today. So 1, every business should be tracking KPIs, at least profit and cash. Every business can do it. Every business should do it. Track your profit, track your cash. You can be setting goals and budgets for those as well. That's a little more detailed, but that's definitely the next step. And just to make sure that if you're tracking any other KPIs, that you're tracking them with a purpose, right? Don't just track numbers because people tell you that that's important. Is that figure, is that number, is that indicator important to your business? All right, that's important to ask. All right. Yeah, So that's our first training. Yay! Today was weird. I went later than usual because I had to rearrange my week. But next week, so here's the thing. On Sundays, I schedule out my week. So on Mondays, I will post when the live for the week will be. But I will try my best to stay as close to or on schedule with Thursdays at 10:30 my time. That's Mountain Time, Colorado time, Denver time, which is 9:30 Pacific, 11:30 a.m. Yeah, Central, and 12:30 p.m. Eastern. So I will make sure that I post every week the schedule and the topic by Mondays so you guys can plan around that. And always remember that you can watch the replays. Let me know also what it is you guys want to learn about. All right. For these first few, I was able to kind of get some content based on the questions for my training session, but that's going to eventually run out. So send your questions in. Let me know what it is you want to learn about. All right. That's it. So until next week, guys, have a fantastic week.